some light on REIT stocks? How is it different from equity?
Okay, so REITs are essentially real estate investment trusts. So what happens typically is, as an individual, you and I can take exposure to real estate, which is typically in a physical form. So I can go and invest in a residential building. I can maybe buy a property which is a commercial property, and I get rental income, and there's a possible capital appreciation that can happen. But the problem is the ticket sizes are huge. So I will have to say in a place like Mumbai, or even in Chennai for that matter, if you have to buy a 1 BHK, I think it will not come in a reasonably good location, nothing less than 50-55 lakhs, right? But in a REIT, what happens typically is, these are just like mutual funds, where you give the money to a fund manager or a portfolio manager who will invest on our behalf. So they will identify the properties, and typically these are commercial properties. It sometimes can be clubbed with a residential property, but majorly it's a commercial property. So they identify the properties where they can invest across the country. So that's a diversification that you get. You and I cannot do that perhaps. And then they will allocate units to us. So now SEBI has, I think, reduced the limit. I think you and I can invest in a REIT for as low as 10,000 rupees. So as compared to a crore of rupees, which I have to invest in real estate. Today, I can get exposure to real estate with as low as 10,000 rupees. And these are traded on the market, just like your shares. And there is a price movement that happens. Now, REITs it is mandated by SEBI for them to distribute 90% of their income. So let's assume that they have earned 100 rupees. 90 rupees out of it has to be distributed to the unit holders in the form of dividend. So which is very similar to like your rental income or yield that you get. Okay. So from that perspective, from a diversification perspective, yes, you can look at a REIT, but please be open to volatility there also. Okay. You need to understand what is the underlying, in the sense, where is it that the fund manager, the portfolio manager has invested? What kind of properties have they invested? And they give you those details, in terms of where those properties are, the underlying assets are. Based on that, you can take a decision. But my request, please do not go beyond 10-15% of your portfolios in these kind of instruments. So this can be your sort of what we call as satellite portfolios rather than the core portfolios. So just from a exposure to real estate perspective, 10% kind of thing you can look at. Okay, but be wary of what the underlying is. Please remember, real estate as its own challenges. We have seen that in the past. Even though people do talk about the fact that real estate can do well, be watchful of a lot of factors, because let me give you a very simple example. Even in commercial real estate now, because of what happened in the COVID period, work from home as a culture is now accepted by a lot of corporates. Okay. So if somebody would have invested in a commercial property and it was assumed to be given on rent, and companies would have sort of occupied those property and then paid rent, a lot of IT companies, I am told, have sort of migrated and had said that we don't want to have these physical office structures. We might as well operate from home. So these are some of the challenges. You'll have to have that kind of foresight to take those judgments. What can happen in the immediate future. And let me tell you that you can safely assume today that a hybrid model will continue in India, which is a work from home plus a physical structure. And slowly and steadily, my guess is that we will move more into a very work from home virtual kind of operation, in the next 5 to 10 years is my guess. So those foresights, decisions, judgments, you will have to be careful of. Time will tell whether those assumptions that we make today are correct or wrong, and therefore only from a diversification perspective, small amounts.